Morning, welcome to One Financial Markets Morning Commentary. I'm Andrew Johnson. We're just going to look over a bit of what happened yesterday in the markets and a look ahead of today before the weekend and a break for everyone to just basically recharge the batteries. So the one I want to look at and the one I've been gassing on about was Euro yesterday and the day before, and we had a lovely rising Euro. Above the 117 level, 117.50s we made. But yesterday it basically gave about half of the appreciation we made from the previous day. And there's really nothing that we can put this down to, apart from potentially technical selling. People taking some P&L, book squaring. You can a multitude of things you can say it was for something which there was no data. The stronger dollar perhaps had an influence, but the key thing that we're probably looking at here is probably more of a technical basis. If you look at the longer dated chart here, we have we're right on a 38.2% Fibonacci retracement from the 2014 fall. Now, before we go any further, what is Fibonacci, right? Well, in technical analysis or any analysis, you try and find something which has a relationship or has a pattern which kind of fits in with the stuff that you're looking at, the figures that you're looking at. Now, there's no real reason why Fibonacci has been chosen or used for this, but he was a 13th century mathematician and he was given the problem to solve of how to work out the growth of rabbits. I know this is a bit insane, but this is what, so he came up with the calculation, which was basically adding the number, each number is the sum of the previous two numbers, and this obviously goes up in increments. And this is how he worked out how the population growth of rabbits would occur, and for some reason works incredibly well at showing support and resistance levels in financial markets. Who would have thought it? Rabbits and Euro-dollar and Fibonacci all have some sort of relationship. And that's all we're trying to find when we're looking at technical analysis. We're trying to find relationships, patterns, things that work together in order to give us some sort of an idea or inclination about where the market's going. So here we are on this 38.2% level here. A break above towards 50 can then potentially mean a move on for full retracement. We still have this area here to get through. And if we don't break above 38.2, there's always the potential for a retracement down to the 23.6 level, or just to hold around this level. So this is the key level here. If we hold around the 116.85, 117 level, going through to the weekend, we can get a bit of a better feel for the market and just see how the dollar works on the back of that. But this is a key technical level at the moment we're looking at. And yesterday's noise, once again I call it, was I think a lot of people getting jittery around that level. And because, 117, it's not been seen for a long time. So when you see levels through that, you get people come in, sell, take positions off the table. We did pull back slightly towards the end in the evening and have settled, as I said, around the 117 level, which is where we should be thinking about what happens next. Here we are in Euro-dollar. It was a slight shock to the system, the reversal yesterday, but nothing that's not unwarranted or not seen before. What we need to take into consideration in the FX market currently as well is indices appreciation and how portfolio managers will have to readjust their foreign exchange hedges. Now, what do I mean by all this? Okay, so if we look at the indices for this month, S&P has appreciated by 1.7%. Dow has appreciated by around 1.8%. Okay. If you are a European or a UK hedge fund manager, in order to purchase these assets, which are in dollars, you need to sell whatever asset your portfolio is. So if you're European, you need to sell euros to buy dollars to then invest in this product, right? So you're effectively short euros now, long dollars and long the index. Now, if you're any portfolio manager worth his title, you then need to do an appropriate FX hedge in order to cover for any foreign exchange fluctuations. So when you sell euros to buy dollars to buy the index, you also buy euros as well to hedge your FX position. Now, what does this mean in the whole bigger picture? This means that when your portfolio of dollar assets appreciates by 1.78%, your FX hedge also changes. So what you'll find at the end of the month is a lot of portfolio managers will have to realign their hedges, right? And this is where you might see some more appreciation in the euro based on portfolio managers selling dollars because to buy euros to flatten up their book. So this is stuff that you might see going later on into, well, today. I mean, it's the last day of the month effectively, and this is basically just people redoing their FX hedges because of the appreciation they've had on their equity positions, and these portfolio managers all hold their portfolios in their underlying national currency, which is of their country. So there are euros. If they have dollar assets, then they need to rebalance them onto their portfolio, but also they will have FX hedges which they'll need to redo as well because the value of their portfolio has changed, and therefore they have to also do an equivalent foreign exchange trade to balance out the new variation. So this is stuff that we look at today. Can have a major effect on the market. We have had say 2% move in the US equity indices, and this could be something that tells today for later today. But it's just something to think about. That there are other investment flows going out there in the market. 90% of the market is speculation, but there are other people doing stuff as well, which we have to take note of. Notable data today: half one US GDP, the health, the expectations of the growth of the country. Quarter on quarter, we're looking at a forecast of 2.6% with a previous of 1.4, which is a whopping forecast. I don't think it will deliver, and I think we'll probably see equities potentially sell off a bit aggressively on this. I don't think it will hit at all. But then with the lower dollar, it will be a buying opportunity again for all those people out there. So we'll wait and see to the half one figures, but I don't expect it to be a hit of any note. And we will look, we look for movement on that figure, which will be very interesting. But apart from today, that's the only figure that of note. Like I say, look out for book squaring, look out for end of month hedge reallocations and movements like that. But it is a Friday, new month starts Monday, so there will be book squaring. A lot of people will just probably not even have positions going into the weekend, and we have to take this into consideration when looking at our analysis. So have a good trading day, but once again be aware that there might not be a lot going on. So it's from me from the front lines. We'll see you on Monday. Bye bye.